In the last year, we snagged 2 of the 5 stocks on our 2024 stocks to buy list when they hit the right price for us. Mo bought Google, I bought Nike. Watch and find out what the 5 stocks I'm buying this year are and the price I'm going to buy them at. Now remember, the market was up a lot this year and every single company on that list, except for Nike, finished the year up. But we're here to be principle-driven investors, which means we don't follow the stock price to determine if we're right or wrong. First stock, Meta. Guys, Meta is my biggest regret because I was one of the few people buying Meta at the lows. In fact, I actually bought it on the $88 low, but I made a huge mistake. I sold in the upper 100s, about 195, because I thought the stock ran up too high and I wanted to lock in some profit. Huge mistake. Now the company's at 590, but guys, this company's incredible. They have 3.5 billion people every single month using their products, whether it's Instagram, Facebook, or WhatsApp. And they haven't even monetized WhatsApp yet. This company is doing an incredible job. And look at this. They generated $52 billion in free cash flow last year, and they're still losing money on the metaverse. That's the incredible part. They're still losing over $10 billion per year on the metaverse. This company is incredible. Great returns on capital, very low debt, $1.54 trillion in market cap, $1.6 trillion in enterprise value. That difference there is essentially their debt. And guys, they have so much free cash flow, so much profit. I don't know what to say besides this is an incredible business. This business absolutely dominates, absolutely does a great job. And when stocks were down, right here, people wanted Zuckerberg fired. People said nobody uses Facebook anymore. And it's like, guys, look at their data. People use this company's products every single day and they're around to stay. So let's take a look at their 8 pillars and see what the story tells us from this perspective. Well, 5-year PE, 5-year price to free cash flow. Those are the X's. The rest are all checks. Guys, this company raised revenue by $90 billion in the last 5 years, which led to $30 billion in net income and $33 billion in free cash flow. This company generates so much cash, it's ridiculous. But remember, when the stock was down, people criticized it because news follows the stock price. And as a principle-driven investor, what we're trying to make sure, one of our pillars of the principle-driven investing, one of our foundations is to say, we don't look at short-term stock price movements to determine if we're right or wrong. We look at the long term. We look at the fundamentals. The fundamentals are phenomenal here. What are analysts saying? $23 per share in profit this year, going to $32 in the next 4 years. Okay, pretty good. Not great, nothing to write home about, but pretty freaking good. And revenue growth from $166 to $243 billion. Again, nothing like Adobe or Microsoft, but still great growth with good margins. Now remember, most people out there are people who say, this company's great, the story's awesome, I'm gonna buy the stock. But remember, what we're trying to do with principle-driven investing is say, guys, there's a story and there's numbers. Our job is to merge them together. Because if you only buy based on a story, you're speculating, you're not investing. And if you only buy based on the numbers, you're just a quant, which is fine. But our goal is to find great companies at great prices. And that's when you merge them together. That's why the stock analyzer tool is so incredibly useful. You have a story. That story is going to affect your assumptions you make about revenue growth, profit margin, multiples, etc. But then these numbers come together with the story to give you the right price to buy. This is exactly why our stock analyzer tool was used over 1 million times in the last year by our members of our community. So let's see what was the last time I brought Meta in. So here are the assumptions I made on Meta for the next 10 years of analysis. Revenue growth, I did 4%, 7%, and 10%. You could argue, understandably so, that these are low. I would absolutely understand that. If the metaverse works out, I imagine these numbers will be higher. Profit margin, I did 27, 31, and 34, and I matched it on free cash flow. Because in the last 10 years, their free cash flow and profit margin has been pretty much the same. Now, PE and price to free cash flow. Guys, ROIC is increasing. Meta basically controls the social media world. This company's around to stay. It's got a moat. People are ingrained in the life of Meta. So you have to pay a higher multiple than the 15 multiple the market dictates. I put 20, 23, and 26. Some of you might say too high, some of you might say too low. That's the art of investing. We don't know the future of this, But to me, a company that can generate and grow its cash flow that much, even though it's losing $10 billion or more a year on the metaverse, deserves that kind of premium. And finally, my desired return, I only put 9% in here, and I do this in every video because I want to show my basic intrinsic value. But guys, you got to put a higher percentage than 9%. 9 or 10% the market average. So if you buy an individual company, you have to put a higher number in for a margin of safety. So I hit the analyze button, boom. I have a low price of $320, high price of $775, middle price of $509. That's what proves me selling at $195 was the stupidest move I could have done. But hey, we live and learn, and it was a great lesson, and it allowed me to stay in other stocks that I have that have skyrocketed above their intrinsic value. Now, as you can see, it's on my watch list at $375 because I haven't done this for a while, but values have gone up. So I'm going to add it at $475. Now, it doesn't mean I'm buying it at $475. What it means for me is, Paul, take another look and start selling puts at lower prices. By the time it hits $475, intrinsic value could be well higher than $509. That's the goal of adding things to your watch list. The software will send you an email. The app will send you a notification. Come check out the stock and hit your buy price. Stock number 2, Adobe. Guys, I just did a video on this the other day. I started a position in Adobe and I sold some puts at lower prices. My position started about where it's at today. It was like $445 or $446. Now, I said in the video, I hope the stock goes to 200 because if I dollar cost average all the way down from 450 down to 200, I'll basically get 325 as my price for Adobe on my average cost. Would I be happy with that? Yeah, I would. Adobe is an incredible company. And I saw comments of people saying, Adobe's going to get taken over by AI. Maybe so. I think Adobe is going to be very helped by AI, actually. Adobe's on the forefront of Photoshop and all these video editing and image editing tools. This is going to be a company that I think is going to prosper because of AI. And look at this incredible range. Look at what happened here. All-time high of 700 back in 2021. It fell as low as, let's see what this low is on the chart, 274. That was the low. Then climbed back up to around 640 or so, and now back down. Guys, this all happened within the last year and a half, 2 years. This is what's incredible about the stock. This is why you can't get too messed up worrying about short-term fluctuations. Are you telling me that the intrinsic value of Adobe fell 70% or 65% in a matter of 1 year? Come on. There's no way. And this is a company, if you look at their financials, look at their revenue. Growth. Come on. There's no way. But use Mr. Market. Use that fluctuations in people's emotions to buy great companies at great prices. So let's look at the 8 pillars. Something tells me it's going to look a lot like Meta, and it does, but it's actually selling for a cheaper multiple because here's what I love about Adobe. Their free cash flow is higher than their net income. People, 99% of investors out there who even pay attention to net income focus on this. You, as a principle-driven investor, realize cash is king. Now, you have to figure out, why is the free cash flow greater than the net income? Frankly, I don't care. I worry when it's the other way around. But I look at this saying, okay, they're generating good free cash flow. They're selling for 30 times free cash flow. Seems like a lot, but this is a company with really high gross margins, 89%. Every extra dollar they bring in, almost 90% of it goes to pay taxes, pay overhead, etc. Hypothetically, if they doubled their revenue tomorrow, vast majority of that's probably going to the bottom line. Why? Because how many more people do they need to have to sell more software packages? So let's check out what analyst estimates are for Adobe. And look at this growth, guys, in EPS. 14.5, 12.5, 11.5, 16.5, 12%, 15%. Higher than Meta. Way higher, going from $18.64 to $35, almost doubling, with revenue growing at double digits, 10.5, 11, 11, 13, 11.5, 11.5. Big time growth in revenue for such a big company, from $22 billion to $38 billion in the next 5 or 6 years. Incredible stuff. So of course, Stock Analyzer, let's merge the story and let's merge the numbers together. We do our analysis. Guys, I did 6, 10, and 14% revenue growth. My profit margin, I put it in there, but ignore it. I did 38, 40, and 42% on free cash flow. I can understand somebody going higher with such a high gross margin. What that means is, literally every dollar they sell extra, their free cash flow is going to go higher and higher and higher. That's a huge number. This could grow even higher. I don't know how much higher, but if they keep adding more overhead, then it won't grow as much. But it's a software business. How many more developers do you need? I don't know. Multiple PE. Guys, I think I'm low here. I did a low of 18, a high of 24, middle of 21. I actually do think I'm low here, but it's up to everybody out there to decide. Hit the analyze button. The stock's currently at 444. I have a low of 381, a high of 960, and a middle price of 606. So based on free cash flow and based on a discounted cash flow model, it's a 13% potential return if my middle assumptions occur based on free cash flow. Stock number 3, Johnson & Johnson. Well, guys, Johnson & Johnson, huge company, and they had a game-spinning spinoff of Kenvue, which took place in May of 23, a while ago, but this move wasn't just a shift in strategy. It was a master stroke. By separating its consumer health segment into Kenvue, J&J streamlined its focus on the high-growth, high-margin pharmaceutical and medical devices businesses, while Kenvue honed in on its dominance in consumer health. It's a classic case of sharpening each blade to cut through its respective market. This is why spinoffs work a lot of times. It allows the company to sit there and say, listen, we've got hidden value in this one division of our company. It's being masked by another division. People are not giving individual value to these companies. So sometimes the parts are worth more than the whole. And that's what they did there. So again, what does this mean for investors? Well, J&J is now laser focused on its high margin businesses while still owning about 10% of Kenvue. And these high margin businesses that J&J can focus on have a proven history of delivering life-changing products. With over $14 billion annually in research and development, it's an innovation machine. And let's not forget, it's a dividend king with over 60 years of increases. But as for J&J stock, let's check it out right now. Company hit an all-time high of 186 back in April of 2022, 52-week low of 142. So a lot tighter range here, like versus the other companies we've been looking at. And it's a pretty boring company, so I understand why that would happen. But look at this dividend yield that people love, 3.3%. And that dividend eats up $11.7 billion of their $18 and $19 billion a year in free cash flow. So it's a lot. It's over 50% of their free cash flow, but this company's pretty reliable, and 60 years of increases on their dividends is pretty amazing things. Remember, dividends can be great, but don't ever buy a company just because of the dividend. I like dividends. I like getting that cash flow stream, but it's the last thing I want a company to do with the cash flow that they receive. So let's see what the 8 pillars look like. Wowza, look at this. And guys, guess what? Net income being down, I don't care. Why? $19 billion in free cash flow, 14.7 in net income last year. There was obviously some write-off or something. So this really should be a check mark for this. Everything else, check marks here, 17 times earnings, 19 times free cash flow, buying back some shares. I mean, guys, it's a nice company. Guess what? You're not going to buy this company and see it go 10x in the next 5 years. Not going to happen. But what you're going to find here is a company that gives you a good dividend, consistently growing its earnings and free cash flow, and probably increasing that dividend over time. And hopefully, if the stock were to fall from the current price of $146 to $70, they take all that cash they're generating and start buying back a ton of shares, increasing your ownership in the business. So let's see what the analysts are saying about Johnson & Johnson. Again, 6.5%, 5.7%, 8.8%, 7.8% earnings per share growth. Not a ton. Revenue growth, basically inflation. 4.75, 2.85, almost 4, almost 6, almost 6. Not much growth here. But remember, you don't need massive growth from some companies. If you buy a company that can just spit off a ton of cash and use it to buy back shares, you're going to be a very, very happy investor when you walk down the street 10 years from now. So let's see what the stock analyzer tool says about J&J for us. All right, so I did 2, 3, and 4% revenue growth. I did 19, 22, and 24% profit margin and free cash flow margin. As you can tell here from the free cash flow, very consistent in the 22% range. Very, very consistent. 16, 19, and 22. Guys, again, I wouldn't be surprised if you said 19, 22, and 25. Where's J&J going? Look at all the products they have. This company ain't going away. Does that deserve a premium? Absolutely. Is it a grower? No, not at all. Is it a high ROIC? Not great, not insanely high, 12.5 to 13.5%, but it still deserves that premium. And of course, my 9% return, I hit the analyze button. The stock's currently at 146. I have a low price of 101, a high price of 184, and a middle price of 140. Now keep in mind, for those of you who have the software, these current price returns include the dividend. So don't think this is 8.4 plus that 3.5% dividend. This is a discounted cash flow model, which is before all dividends. So this is still including the dividend. Now, I talk about these companies and the stock analyzer tool because investors inside of our community, you ready for this, have analyzed over 4,600 stocks in 2024 alone. And J&J happens to be one of the stocks that our community has discussed a lot and analyzed a ton within the chat in our community. If J&J is on your radar, you absolutely need to go inside the community and have a conversation about it. So if you're new to our channel and want to visit our site, you're going to notice that we have a waiting list at everythingmoney.com. The reason for that is today's software includes everything we have to offer about stocks, retirement, and real estate, and all of these amazing tools. But behind the scenes, we're making amazing changes. So in a short period of time, that offer is going to go away. Now, for those who are new, what you don't know is I first built the software just for me. When we first started this channel, the software, every single thing here was just an Excel sheet or some website made for me. But as we made videos, the most common comment we got was, how do I get that software? And I kept saying to people, you can't get the software. It's an expensive data feed. But of course, it triggered a wonderful idea. Let's make it for everybody. And that's why now we have thousands of people using it, because it changes the way in which they not only analyze and talk about their real estate, retirement, everything like that, but it gives them a community of people to go talk to. And guys, we don't do real estate on this channel. This year alone, I bought over $30 million of real estate using this real estate calculator. And I just came across my desk yesterday, a $44 million portfolio that we're very close to getting. And hopefully we do get it. And it's all done through our real estate calculator. These are all things that I use every single day and my team uses every single day. And this is exactly why we have to update our software constantly. But now it's also about giving more to you than to myself. The good news is these changes haven't been made yet. So if you join today, you'll be grandfathered in for life with everything here. And this is the best deal we have ever offered. I'm telling you this now because there's still time for you to sign up. So go everythingmoney.com or click on the link in the description below before we make the changes. It's $7 for 7 days to try it out. It's the easiest and simplest $1 per day you'll try in your life and probably the best investing decision. So start the new year off right. Get yourself in the right mindset with the community and the tools. Now, stock number 4, the Googly Moogly. Actually, it's down today. Wow, look at that, 192.69. Look at this, guys. This company had $88 a share. At $88 per share right here, people were saying, fire the CEO, search is dead. I literally heard people saying search is dead. Now, you might sit there and say, I never thought that. Yeah, you probably didn't think that. But there are people out there who say that. And my comment to people is, guys, the top 2 search engines in the world, Google.com and YouTube, the very channel you're watching us now. And they're both owned by Google. Google paid like $1.6 billion for YouTube back in 07, 08, and it generates tens and tens of billions of dollars a year in ad revenue. It's an absolute juggernaut. And look at these amazing numbers here. $2.4 trillion market cap versus a $2.4 to $2.5 trillion enterprise value. It's incredible, guys. I mean, it generates tons of cash flow. Now, the one thing I will say that I don't like is net income and free cash flow are very separated here. I'd want to be able to understand why that is, because that's a big discrepancy. But one of the reasons is their capital improvements greatly increased in the last year. Probably has to do with Google Cloud and their cloud-based services and building a lot of data centers. But that's, again, something you can have a great conversation in the EM community, because I'm sure there's someone out there who's read the 10K. And if you want to see the 10K, you click right here at Annual Reports. It takes you right to the Google SEC website. You click 10K, find it, open it, you're right there immediately. So let's see what the story by the 8 pillars is. Guys, like all the companies we look at, it's all great stories here, just waiting for the right price. Again, marrying the story with pricing. You've got to remember that. That is what makes a true investor. Now, let's see what analysts are saying about the numbers on Google. 40% increase in EPS this year, 12%, 14.5%, 12%, 21%, going from $8.25 to $14.40, with revenue growing at 14.5%, 11.5%, 10.5%, 7.5%, 9%. It's a grower, guys. $360 billion in revenue last year, growing to $522 billion according to analysts. Let's go check out that stock analyzer. So I did a 10-year analysis. I did 4, 7.5, and 11% revenue growth. I did profit margin and free cash flow of 22, 24, and 26. I did a PE of 20, 23, and 26, and my 9% desired return. The stock's currently at 193. I have a low price of 120, high price of 292, middle price of 190. Now, I have in my watch list at 145. I need to increase that. I need to increase this and add it to my watch list at probably 175, actually 180. But again, it's not to buy it at 180. It's to sit there and sell puts on it at lower prices. I like generating 10, 15% of my cash by selling cash secured puts, which means I can buy companies that I love at lower prices. Another thing that people in our community do, and you got to learn how to do if you're able to buy over 100 shares at a time. You can be paid to buy a stock at a much lower price. Now, before we go any further, guys, I want to update everybody on SCHD. We made a big video about SCHD, and I've talked about how I see the value in it. Now, recently, I was fortunate enough to have an exit on a company I own, and it gave me a very large sum of money just this past Monday. I'm going to use this money. My goal is this one check I got is to live off that the rest of my life. And since I don't need to make insane amounts of money, I'm being smart and saying, just put this in an investment that you understand and that you like. But I'm not going to go all in on it, even though history shows it's best to take a lump sum and put it all in. I'm going to dollar cost average into SCHD. Every single month, I'm going to buy X amount of dollars. I have the money sitting in money market or treasuries, earning cash, and every month buying a certain amount of SCHD and selling puts on lower prices for SCHD so I can earn extra income on my cash as well as build this position. Now, keep in mind, I still have 1,000 units and growing upstairs. I still have many businesses, including this one. But my goal is, part of my way of thinking about money lately changing is saying, this is the money I'm going to live the rest of my life off of. If I could just do that, and it's 1/5 of my net worth. It's 20% of my net worth. I'm going to sit there, put it in an account, and have that money grow very consistently with something that makes sense. Because if I'm going to live off of it, I want that dividend. And now my final stock, a stock that is going to be hard to go away, but it all depends on what the future of money is. Let's go find out what's going on with good old Visa. Great, great company, huge margins, guys. Look at these margins. 53, 52, 55% on gross margin of 80%. To be honest with you, I'm surprised the gross margin isn't higher. Guys, dividend yield, 0.66%, eats up $4.2 billion of their $16 to $19 billion in free cash flow. I mean, guys, 22% to 26% return on capital. Guys, as the world gets bigger and bigger, imagine how many people in the world don't even use credit cards yet. Let me put it this way. There isn't exact data, but in 2021, about 21% of the people over the age of 15 around the world use a credit card. And in Canada, it was the highest at like 83%. Imagine how many people in Africa don't use credit cards, in India don't use credit cards, in China don't use credit cards yet. These are amazingly fast-growing economies that as the world gets bigger and more economically independent and people are able to make more money, credit cards become a bigger and bigger thing. Who's going to lead that charge? You're telling me that Visa's not going to be on top of that? It's absolutely going to be an amazing revenue generator for them. This is a company that absolutely deserves a large premium. And guys, I'm going to look at analyst estimates here. Such a large company, look at these EPS growth, 14.5, 13, 13, 13, 19%. Revenue growth, I'm actually surprised at only 10% a year. I'm looking at this and going, okay, so let's see Visa. Let's look up the last time I pulled up Visa. Now, before I did 5, 8, and 13% revenue growth, I'm going to do 6, 10, and 14%. I did profit margin and free cash flow. Now, historically, the free cash flow has been higher than profit margin. Okay, so I'm going to sit there and focus on the free cash flow. I'm going to sit there and do 50, 53, and 56% for both. PE, guys, 20, 24, and 28. Maybe better, I don't know, but my 9% return, the stock's currently at $319. Guys, look at this. A low price of 206, high price of 550, a low price of 340. These are high assumptions here, but you have to pay a premium for great companies. So I'm going to change my watch list price to $300 per share to notify me so I can take a look at this company and see what puts I want to sell at lower prices. So guys, if you want to see my video, my top 5 stocks that I own, check out this next video. Thank you for your time.